Welcome to Counters. In this lesson, we're going to be looking at trade payables. We're going to explain what it is, why it's important in accounting, and how to account for it. First of all, when you're doing the journal entries for trade payables, as well as how it's accounted for in the annual financial statements. So if it's your first time looking at trade payables or you don't understand what it is, this lesson is for you. After this lesson, you should be able to have a good grasp of what it's all about. Another word for trade payables is accounts payable or debtors, as you'll notice as we go along. We've also done a lesson on trade receivables, a lesson very similar to this, but you'll be able to see the differences between the two. We've also done a lesson on trade payables versus trade receivables. You'll find the links to all those lessons in the description below. Additionally, we've gone through a thorough example in completing a trade payables general ledger account. So if you'd like to check that one out, you'll find it in the link in the description below as well. So what is trade payables? How do we define it? Well, trade payables are defined as amounts owed by a business to suppliers for goods purchased or services received on credit in the ordinary course of business. And so that line just sums it up. Trade payables is when a business has bought on credit, not on cash, and they now owe their supplier the money. So usually if you're a repeat customer and you're buying from your supplier, you have credit terms with them where you can buy goods and only pay later. And you would record your supplier as trade payables because these are those that you owe money to. That makes trade payables a liability, okay, because you owe money to your suppliers. That should be clear. Now here are important things to take note of when you're dealing with trade payables. Trade payables are classified as a current liability and appear in the statement of financial position. So if you know the statement of financial position, you know we record three main things. You've got assets, you've got equity, and you've got liabilities. Under liabilities, you've got non-current liabilities and current liabilities. And so trade payables would appear under current liabilities because it's something that we are working with on an ongoing basis, or we are buying goods or services often on credit, and that is why it's a current liability. What is a liability? Liability is whatever you owe other people, okay? So that's a liability, meaning that you are due to pay them back. And so that is why it would be classified as a liability and current liability at that. And it would appear in the statement of financial position as we've just explained. So you just have to take note of that. When you're looking at your annual financial statements and you want to know where is trade payables, you just go to the statement of financial position. Under liabilities, you'll see non-current liabilities, which are liabilities that will pay over a period of longer than 12 months. And you'll see current liabilities. Under there, you will see trade payables or trade and other payables, but we'll explain that shortly. Now, as I've already mentioned, only credit purchases and not cash purchases are recorded as trade payables. And so whenever you buy from your supplier in cash, that has nothing to do with trade payables because trade payables is a liability, something that you owe to your suppliers. And so if I bought from them on cash, I don't owe them anything. But if you buy from them on credit, that would qualify as a current liability. And that is why we are saying it's only credit purchases. What do we mean by credit purchases? It means that you're buying without paying them at that point in time, and you'll only pay them at the later stage. Trade payables can also be referred to as account payables or creditors control or just payables. So if you see any of those terms there, you know that it's usually used interchangeably. Accounts payable, creditors, or creditors control even. It would be referring to trade payables. So you just have to remember that when you're seeing these other terms being used, it's not different from your trade payables. Trade payables are a source of short-term financing for the business, and that is why it exists, and that's why it's important, as they allow the company to use goods or services before payment is made. And so why would a business decide to buy goods on credit as opposed to just paying cash and getting it over and done with? Well, that's because instead of the business paying cash to the suppliers, they can get the goods, sell the goods, and then get cash from their customers and use that cash to pay their suppliers. And that means the company has more cash flow to do whatever it needs to do, whether that is the day-to-day running of the business, or that is expansion, or that is investing. That's what trade payables allows the business to do, because you're only going to pay your suppliers at a later point in time. And as I mentioned, you have credit terms with your suppliers. Your suppliers might give you 30 days, that's usually very common, or they might give you 15 days or 45 days or even 60 days, depending on the industry you're in and the relationship that you have with your suppliers. And so that's what you'd be dealing with if you're in business and you have trade payables, you would know that. And so this slide has just explained in a nutshell what trade payables is and what are some of the important things that pertain to trade payables. Now, what are the subsidiary books and ledgers that relate to trade payables specifically? Well, here we go. Firstly, the subsidiary books related to trade payables. The first one we have here is purchases journal. And so if you want to create a journal for your trade payables, this would be one of them. Purchases journal. And what do we mean by purchases journal? Well, this records all credit purchases of goods or services. And so whatever goods or service you buy on credit from your suppliers, you record it under the purchases journal. Whatever is recorded under this journal, as you can see here, it's highlighted. This increases trade payables. It increases how much you owe your suppliers because you are recording how much you are buying from them on credit. And so if I want to know how much I've bought from my suppliers on credit during any specific period, whether it's a month, then I would go to the purchases journal and I'll see what the credit purchases were. We've done a lesson specifically on purchases journal. You'll find the link to that lesson as well in the description below. What other subsidiary book do we have that relates to trade payables? Well, we've got the purchases returns journal or returns outwards journal. So any of those terms may be used. And what do we record here? Well, it records goods returned to suppliers who sold the goods on credit. Okay, and this decreases trade payables. Why is that? Well, we are returning goods to the suppliers. We bought from them on credit and now we are returning the goods to them. Why are we returning the goods? Well, maybe they are faulty or they are incorrect goods or they were not of the required quality. And so whatever the reason is, if we return goods to our suppliers, we record it under the purchases returns journal or the returns outwards journal, and it decreases trade payables. Why is that? Well, that's because whenever we return goods to them, we no longer owe them for those goods, and so it reduces how much we owe our suppliers. That means our trade payables is reduced. We've done a lesson on this one as well. If you'd like to know how to do the purchases returns journal, you'll find the link to that lesson in the description below. What other subsidiary book do we have here for trade payables? Well, cash payments journal, and I'm sure this is familiar to you because it's quite common and it includes cash paid to creditors. Remember, cash payments journal records all the cash outflow of the business during any given period, whether it's a month or a quarter or even a year. Whatever is recorded in the cash payments journal shows you the money that left your account for whatever reason, one of which is payment that you've made to your creditors. And so usually in the cash payments journal, you have a column for creditors or trade payables, and whatever amount is listed under that means that it's the money that you have paid to your creditors. That means you don't owe them any longer for whatever you've paid them. That means it decreases trade payables. So you can see here whatever we've written in green and highlighted in black shows that the subsidiary books do decrease our trade payables. And so if I want to know during a given month, for instance, how much did I pay my creditors or my trade payables, then I would go to the cash payments journal and I'll find a column for trade payables, or I'll see it in the sundry account and I will be able to determine how much that was. And usually you'll see the total at the bottom as well. Again, we've done a lesson on the cash payments journal. You'd like to check that one out, you'll find the link in the description below. Okay, so we've gone through the subsidiary books that relate to trade payables. What about subsidiary ledgers that relate to trade payables? Well, here we go. We've got one subsidiary ledger specifically related to trade payables, and this is the Trade Payables Ledger. And what is this? Well, this is a ledger that contains individual accounts for each supplier and tracks the amounts owed to them, i.e. credit purchases, payments made, discounts received, and returns to the suppliers. And so if I want to see what movements do we have or how much I actually owe any supplier at any given point in time, then I'll go to the trade payables or the accounts payables ledger, and there I will see each specific ledger and how much I've bought from them, how much I've paid them, whether they've given me discount or whether I've returned goods to them and now it reduces how much I owe them. If I want to see for specific suppliers, I will go to the trade payables ledger. And so that is opposed to the journals where it records everything for all your suppliers, but in the ledger I want to see specific suppliers and the movements during any given period, then that's where I would go. I've done a lesson specifically on this one as well. You'll find it in the link in the description below. But you can see here we've got the subsidiary books and subsidiary ledger that relates to our suppliers, and specifically those from whom we bought on credit. And so I hope this gives you an idea of how to deal with trade payables and how it's dealt with and where you'd go to find information regarding your suppliers or your trade payables. So how do we journalize trade payables. So what do we record when we have either bought on credit from our suppliers, or we are paying our suppliers from whom we bought on credit, or they've given us a discount, or they've even charged us interest for overdue amounts that we didn't pay on time? Well, here we go, journalizing trade payables. The first thing that we need to remember is that an increase in trade payables is recorded as a credit, while a decrease is recorded as a debit. Very important. And why is that? Well, that's because trade payables, as we've just explained in the first slide, is a liability, and our liabilities increase on the credit side and decrease on the debit side. And so you just need to remember that. Whenever I see my trade payables on the credit side, I know it's increasing. Whenever I see trade payables on the debit side, I know it's decreasing. And that's what you would do as well. If you need to decrease your trade payables, you record it on the debit side. If you need to increase your trade payables, you will record it on the credit side. And if you remember this, we've got an acronym specifically for that, and we've done a lesson on that specifically. You'll find it in the link in the description below, called Accounting for Beginners Part 1, which is quite helpful in understanding the very foundation of accounting and accounts such as this. And so here's our acronym. We've got DED click. And what does it stand for? Well, D stands for debit, expenses, assets and drawings, and C stands for credit, L stands for liabilities, I stands for income, and C stands for capital. So you would remember this if you've been following our channel for some time. But you can see here we credit our liabilities. Okay, we always credit our liabilities when it's increasing, we debit our liabilities when it's decreasing. And you can see why it increases on the credit side, because trade payables is a liability. And so let's look at some examples here. What do you do when you buy goods on credit from your suppliers? What do you debit and what do you credit? Well, here it is. You either debit purchases or inventory, and you credit trade payables. And I'll explain now when do we debit purchases and when do we debit inventory. But you can see here we're crediting our trade payables because we've just bought from them on credit, and you can see here the narration is bought goods on credit. So whenever you buy goods on credit, the first thing that should be clear on your mind is that we're crediting trade payables. Now, as to what we debit, that depends on the inventory system that we're using. If you're using the perpetual inventory system, then you will debit inventory. If you're using the periodic inventory system, then we will debit purchases. What's the difference between the two? Well, the periodic inventory system means that we are only accounting or counting our inventory at specific points in time. That could be the end of the month or the end of the quarter, depending on the industry you're in, and of course the policy of the entity. And so we're not continuously accounting for our inventory. But if you're using the perpetual inventory system, which is most companies these days, because of advancement in technology, where when one product is sold, it's scanned and the system automatically records how much inventory is left. And so that's the perpetual inventory system, where we are continuously accounting for our inventory. If you'd like to understand more on that, you'll find a link in the description below for a lesson on the perpetual inventory system versus the periodic inventory system and how journal entries are done with each of them. And so that should make it very clear. But in a nutshell, it's what I've explained. You debit purchases if it's the periodic inventory system, and you debit inventory if it's the perpetual inventory system. But crediting, we know it's trade payables whenever you buy goods on credit. Remember, when you buy goods on cash, it has nothing to do with trade payables. As we've already explained, you would credit bank in that instance because money is leaving your account, because bank is an asset. But if you're buying on credit, you credit your trade payables. What about in an instance where you're paying your creditor? Remember, when you pay your suppliers for goods that you bought from them on credit, that reduces your trade payables, as we've already explained. That means we're going to debit our trade payables. Remember, liabilities increase on the credit side and decreases on the debit side, as this sentence has already mentioned. So here's how it's going to look. We debit our trade payables and we credit our bank, because money is leaving our bank account, and our narration there is payment to creditor. Your narration might be slightly different from someone else's narration. It doesn't mean it's wrong, as long as you're explaining what's happening in the journal entry. But the journals themselves, or the accounts themselves that you're debiting and crediting, have to be exact. So always easy. Whenever you pay your creditor, you debit your trade payables and you credit your bank. And in a case when you have not paid your supplier on time and they are now charging you interest, what do you debit and what do you credit? Well, whenever they charge me interest for overdue accounts, or I haven't paid them based on the agreed upon credit terms, then you know the trade payables will go up, meaning I will end up owing them more because they've just charged me interest. And so if I owe them more, that means I'm crediting my trade payables. So here's how it's going to look. You credit your trade payables, as I've mentioned, but you debit interest expense because they've just charged you interest for not paying them on time. And you can see here the narration, interest on overdue account charged to company. And so why are we debiting interest expense? Well, because interest expense is an expense account and it increases on the debit side. As you can see here, we debit expenses. And in an instance where we are paying them on time, or we're even paying them early, and based on that, they're giving us a discount. What entry do we pass here? Well, firstly, we know when we're paying our creditors, it reduces how much we owe them. We debit our trade payables. Secondly, whenever they issue us with a discount, it means we now owe them less. We also debit our trade payables. So here's how it's going to look. We debit our trade payables and we credit discount received, and we also credit bank. And here you can see the narration says payment to creditor with the discount received. Now I must explain here that you don't have to capture it in one entry. You can do it in two separate entries where you debit trade payables and you credit discount received with the amount for the discount, and then you do a second journal entry where you debit trade payables and you credit bank. It comes to the exact same thing. Otherwise, if you do it the way we've done it here, you are also correct. And so this is a quicker way of doing it as opposed to doing two journal entries. So whatever works for you or whatever is preferred by your examiner or your lecturer, if you're studying, then you can do it that way. But I hope you understand here, whenever they issue me with a discount, I will debit my trade payables and I will credit my discount received. Discount received is an income account, and our income increases on the credit side, as you can see here. And bank, of course, is an asset. It's going down because I'm paying them. And so let me give you an example. If I owe them 10,000 rand and they tell me if I pay within 10 days, they will give me a 10% discount, which is 1,000 rand. That means I will only pay them 9,000 rand. But my trade payables is going to decrease by 10,000 rand. So I'll put 10,000 rand on the debit side for trade payables. My discount received is going to be the 1,000 rand, the 10% of 10,000 rand. And my bank is going to be the 9,000 rand. And so you can see my debit still equals my credit. My debit is 10,000 rand for trade payables, and my credit is 1,000 rand for discount received and 9,000 rand for bank if I'm paying them. And so this is how you'd go about journalizing trade payables transactions. And I hope it makes it more clear as to how you handle transactions such as this. Now, how do we account for trade payables in the annual financial statements? That's a very important thing to look at and to understand, so that you can see how it affects your annual financial statements, how it's recorded, and where to find trade payables if you're looking at the annual financial statements. Well, here it is. Firstly, trade payables are shown under trade and other payables, which are classified as current liabilities, as we mentioned in the first slide, in the statement of financial position. And so we've already mentioned this. It goes in the statement of financial position and it will be under trade and other payables. And we'll explain now why the word other is there, because it may not just be trade payables, but you'll see shortly. Secondly, purchases, both cash and credit purchases, are reported in the statement of profit or loss, or the statement of comprehensive income, or the income statement. Those terms may be used interchangeably, as part of cost of sales. And so whenever we buy from our creditors or from our suppliers on credit, that will form part of our purchases or cost of sales. Okay, so it will appear in the statement of profit or loss under cost of sales, provided of course whatever we've purchased from our supplier has been sold. And so if we've bought on credit from our supplier but we've not sold the inventory as yet, then it would not form part of cost of sales. So that is something important to take note of. We only record whatever we bought from our suppliers on credit as well as on cash as part of cost of sales if we've already sold that inventory to our customers. Thirdly, purchase returns are subtracted from purchases to reflect net purchases. And so we've already mentioned the subsidiary book that relates to trade payables. And one of them is purchases returns journal. Whatever we've returned to our suppliers is deducted from purchases to reflect the net purchases at the end of the period. And fourthly, in the statement of cash flows, trade payables are included as part of changes in working capital under operating activities. And so you'd understand this if you already know how to do the statement of cash flows. But if you don't know or you've not done it before, then you might want to check out a lesson on the statement of cash flows, which we've done as well, and you'll be able to see where trade payables comes in there. But you will note that it does go under the operating activities section and it's part of working capital. An increase in trade payables is recorded as a positive adjustment, indicating cash retained by delaying payments. And so if there's an increase in trade payables from the previous year to the current year, or from the previous period to the current period, then that is a positive in the statement of cash flows. Not because it's a good thing for the business necessarily, but only because we owe our suppliers more, meaning we didn't spend the money for the goods that we bought from them. That means in terms of cash flow, it's a positive. And so like I said, you might want to check out the lesson on the statement of cash flows if you want a deeper understanding on this. But a decrease is recorded as a negative adjustment, indicating cash outflow to settle payables. And so the vice versa is exactly true. If my trade payables from the previous period is greater than the trade payables from the current period, meaning it went down, that is going to be reflected as a negative in the statement of cash flows because it went down as a result of us paying our creditors, meaning it's reducing the money we have in our bank account. And lastly here, discounts received, which is an income account as we mentioned in the previous slide, for early payment directly reduce trade payables, as we've mentioned and as we showed you in the journal entry, as the liability to the supplier is settled at a reduced amount. And the previous slide made that very clear. So how would it appear in the statement of financial position specifically? Because we've already mentioned here that trade payables will be part of trade and other payables. That means when you see the line item under current liabilities of the statement of financial position written trade and other payables, it may not just be for trade payables, it might include other payables as well. So let's have a look at that. Here we go, trade and other payables in the statement of financial position. This includes not only trade payables, meaning amounts owed to suppliers for credit purchases, but also other liabilities. And what are these other liabilities? Well, you will see something like this on the notes to the annual financial statements pertaining to trade and other payables. Here is an example. Notes to the financial statements, and specifically the statement of financial position, and it could be note number 1, number 2, or number 10, or number 11, depending on the number of notes that are there, explaining the amounts in the financial statements. And here we've got trade and other payables, and it shows you a breakdown of all the trade and other payables. And so this is what you would do, explaining specifically what is recorded under trade and other payables. It could be only trade payables, but usually it includes other line items as well. And so you can see under trade and other payables for a specific financial statements, the first one is trade payables, meaning whatever we owe our suppliers from whom we bought on credit. And it could also include other payables like VAT payable. So if we owe the revenue authority, or we have not filed our VAT return for a specific period and we owe them, then that would form part of other payables. All right, that's why it's written trade and other payables, not just trade payables. And so you can have trade payables, you can have other payables like VAT payable, and you can also have accrued expenses. What are these? Well, these are expenses that have been incurred but not yet paid. And so any accrued expense would form part of trade and other payables. What is an example of an accrued expense? Well, telephone payable. If you've received an invoice and you've not paid it by the end of the financial year, maybe it's for the final month of the financial year, and you only pay it by the 7th of the following month, for instance, because you're only receiving the invoice after the month has ended, then that would form part of accrued expenses. To understand more on accrued expenses, check out our lesson on Accounting for Beginners Part 4, and you will see that. But all that to say is that when you see the line item written trade and other payables, it's not necessarily only whatever you've bought from your suppliers on credit. It can include other payables as well. That's why the word other payables is there. It's not just trade payables. And you will go to the notes to the annual financial statements and you'll see what is included as part of trade and other payables. And the obvious one there is trade payables, but you'll also see other payables as well, which are liabilities that we will settle within the next 12 months. That's why it's under current liabilities. I hope this lesson has made sense. I hope you've gained value from this lesson and you have a thorough understanding of what trade payables is. Now, if you haven't already, you can go check out the lesson where we did the T account for trade payables, or check out the lesson where we explain trade receivables in exact same detail as we have done in this lesson. Otherwise, if you have gained value, consider subscribing to our channel, like this video, share it to those you think it might help. And if you'd like to support our efforts, you can join our channel where you'll get access to a number of documents where we regularly upload more, as well as some videos which are exclusively for our members. Alternatively, you can click on the thanks button and follow the prompts as you see fit. Till next time, cheers.